So before we even get into those procedures, we need to know what happens when a client actually, when a firm decides whether or not they're going to accept a client, right? So what is the client acceptance process like? Matter of fact, what are they even doing here? What's the decision that the client's trying to, or not the client, but the auditing firm's trying to make here, right? Should they accept the client or not? Do they even want to enter into any sort of relationship with the client, whether or not to begin it, right? So this is part of their quality control system, whether or not to engage with a certain client or not, because audit firms aren't required to accept everybody as a client. If Arthur Anderson subsequently knew what was going to happen with Enron, or the type of relationships or the type of unethical procedures there, they probably wouldn't have entered that particular relationship. We can argue about that. Maybe they would have. So here's where they're deciding whether or not to enter into a relationship with the client. So what's the difference between a client acceptance process versus a client continuance process? The easiest way to remember this is that at the beginning of every audit, right, there's either going to be one of these two things happening: the client acceptance process or the client continuance process. The client acceptance process happens whenever they're initially accepting a client. The client continuance process is just deciding whether or not we're going to continue with that client. So after the first initial acceptance as a client, every year the audit firm decides, or the public or accounting firm decides, whether or not they were going to continue with that client. And so let's learn about what happens during this continuance / acceptance process before we get to the predecessor auditor. What are some things that you would want to know about a potential client before you accept them? Like, if you were an audit firm, what is it that you would want to know? Some of the basics, who their management is, right? You would definitely want to know who their management is, because they're the ones running the company. Very good. What else would you want to know? You want to know what this client actually does. What is the nature of their business? Very good. Have they been in the news lately? Recent news articles, right? If you were accepting Wells Fargo as a client maybe about 11 years ago, they might not have been in the news as much as they would have been in 2015 when some of those scandals actually happened. What else? What else would you want to know before accepting the client? As much as you could before actually going in there and looking at them, yeah. If you had any information about that, I would want to know. Any disagreements, like from the previous auditor? So some of the things that happens in this continuance, or if it's before the initial engagement, it's called the acceptance process. You want to know financial information, right? If they're a publicly traded company, which is what we're talking about here, you have access to all of their previous financial statements, don't you? So you would look up that and review that financial information. You're going to do a background check on the senior management. We know that management is responsible for the internal controls. As Reddy mentioned, they're responsible for the financial statements. We want to know who these people are. Then you're going to make inquiries with people like their bank, the lawyers, the underwriters, analysts, anyone that they do business with. You're trying to get information about who they are, as well as easiest thing you can do about what a client is, do a Google search, right? Find out if they've been in the news. But as a firm, you also need to decide whether or not taking on this client has any sort of unusual risk, or if that particular audit would need special attention. Like, will we have to hire a specialist for that? You want to know that before you take on the client. You also want to make sure and decide if there are going to be any independence issues with the firm as a whole with that particular client. But as somebody mentioned before, I said, hey, we would want to know, and were there any issues with the previous auditor? Were there any issues in the previous engagement? And so what role could or does the predecessor auditor play in this process, right? The predecessor auditor is the auditor that previously audited that client, right? They're going to have a wealth of information. However, that information is confidential. They cannot just disclose it if anybody comes up and asks them for it. They have to have explicit permission from the client. And what if they don't give that permission? What does that tell you? As a new auditor, the client's like, no, I don't want you to talk to the previous auditor. That's a red flag, right? As you're doing your due diligence, you're like, why is it that they wouldn't want us to? Remember, we're skeptical of everything. So we're critically saying, why wouldn't they want us to do that? So let's say if I am PwC and I want to take on Target as a client, I'm required to ask their predecessor auditor, right? I'm required to attempt to contact them. However, one, I do have to get permission from the client first. And two, the predecessor auditor is not required to talk, but under the standards, I'm supposed to make that attempt as a new auditor. So what happens if the client doesn't give you permission? Well, you can't talk to that auditor, but that should be a red flag. What happens, we'll talk about other things when we talk about what it's like to be the firm that leaves, like when we talk about the termination letter, so we won't get ahead of ourselves. So the client has to give permission for the new auditor to contact the predecessor auditor. But what kind of things could they possibly get from the predecessor auditor, the previous auditor? Get some information about management's integrity. If there were any disagreements that had like over accounting principles per se, and why did they leave?